Okay, let's answer some questions from the last market outlook and a lot of opinions on the work from home comment that I made, mostly pushback, which I assume is from people who work at home. So when I get to those comments, I'll share with you a recent study Microsoft did on its own workforce about work from home. Okay, first one for the portfolio construction series. I have a question on the paper trading account balance. Do we have to follow the $1 million balance you were using for the construction? Or could we pick amounts to simulate the size we would start with? You can start with whatever you want. You can start with 100,000 if it simulates something closer. Once you get down to 10,000, it's going to be hard to simulate everything that I'm doing. So you're going to have to pick one of the approaches. Either your 10,000 will be buy and hold, your 10,000 will be a Theta allocation, or your 10,000 will be a momentum allocation. And if you're doing that, following one strategy, you don't have enough room in your portfolio to have different sleeves following different strategies, rules are going to become extremely important. It's okay to run concentrated strategies. It's okay to have one particular strategy, like an income strategy, where you're going to manage a Theta portfolio and that's it. If you do, your rules become even more important to stick to. You can't let them go. You can't just say, oh, you know what, I probably should close this option now because it's at the limit of the loss I should be taking based on a rule, but I think the underlying might recover. Let me just hold on a bit longer. You can't do that. You can't have these psychological stops. You have to have the hard stops in place because you're playing probabilities. And the law of large numbers says if you play probabilities the right way over large numbers, you will win. So yes, you can have whatever size that you want. The 1 million size is really just to train with. It's so that you can get a feel of the buy and hold portfolio and when to rebalance, that you can get a feel for Theta using a $50,000 allocation and how that works. And then you can pick and choose whatever you like. I work from home 90% of the time, and I can tell you I'm much more productive at home. Less distractions, that's it. It's easy to imagine that would not be the case with others. So let me tell you about the Microsoft study. It was, I think, 20,000 people were involved in this across a number of countries to control for country effect. And it had two groups, two cohorts. It had managers, and it had the direct reports to those managers. And it asked, it was a survey-based question that asked questions like, do you feel that you put in more hours? Do you feel that you're more productive? All of those things. And for the employees, by far, yes, they felt they were far more productive at home. Far more productive at home. For the managers, 80% said nope. Not by measures we have. No, they are not. And this follows along, this over here, follows along a lot of research that demonstrates that people have a much higher perception of their abilities than they actually do, that they are overconfident about their abilities. From everything, if you ask a group of people in a room, are you a better driver than the average driver? Now, the average is the average. Only half can be above the average, half below the average, but 80 to 90% of people always feel they're above the average. So when you ask them, do you feel that you're more productive working at home? Most of them, honestly, probably feel that they are. But by measures of productivity, managers are saying no. 80% of the managers say no, they are not. When COVID hit and we had to send people home, here's what I noticed. The level of input into the system, because questions get input to the system, features get added to the system, dropped. And not a little, dropped significantly. At the office, you send an email in, usually within 5-10 minutes later you get a reply. As soon as everybody went home, you send an email in, a couple hours later, maybe you'll get a reply, maybe later in the afternoon, maybe the next day. the pace of communication slowed down significantly. The speed of input dropped significantly. I even was experimenting with work from home well before the pandemic. 2017, I hired my first employee in April. And during the course of that summer, I said, because it was summer, kids are off and there was nobody at home, so I said, well, why don't you work from home one day a week and offset some of the extra burden or some of the cost of bringing them to daycare or whatever. So every Wednesday, just go and work from home. So Tuesday night, take the computer home. Thursday morning, come on back. And on Wednesdays, because this person was entering questions into the question bank, into the system, I knew how many questions could go in a day. I could count them. I knew how many could go in a day. On Wednesdays, they dropped in half. So this went on for the summer, and then I just canceled the Wednesday. And I made a point of mentioning, when you're at home, the amount of questions you put into the system drop significantly. And the pushback was, because they knew right there. I find that whenever there is work from home and I'm dealing with people who I know are working from home, communication is really slow. You send an email in and it's several hours later you may get an answer because they're not in front of their computer. They're either out back or doing laundry or taking the opportunity on a Wednesday at 2 p.m. to go to Costco when nobody is there and they can get in and out rather than going on a Saturday. So later on, there's a comment that says, speak for yourself. I am speaking for myself. I'm speaking from experience of work from home. I am speaking from experience. And this study, I think, is one of the better ones that were done. And this study mirrors the Stanford study. If you look up the Stanford study, there's also a Harvard study. All of them are pretty much saying the same thing. Managers at a lot of companies that had adopted the work from home are now reversing it, saying, okay, well, look, you got to be in the office at least, you can't stay at home all the time. You got to be here at least 2 days a week. And some are saying at least 3 days a week. So they're going to a more hybrid model than straight work from home. But I find that this one here was probably one of the better ones because when you talk to people who do work from home, all of them claim to be more productive. But if you ask anybody if they're better than the average driver, 80-90% of people feel they're better than the average driver. I have found that most people who aren't very competent at a task think they're very competent at a task. So it's the self-perception that is unreliable, but this is far more reliable. My experience has been almost to a person, not 100%, but almost to a person. That communication slows down and productivity drops. It's the speed of communication especially. And I put this challenge out there before. You set up a team. Pick your team. Pick the best people you got. You set up your team, and you're going to work from home. And I'm going to select my team, and I'm going to work in an office. And our goal is to build an online sports selling site where we sell sports equipment. I will beat you to market and I will beat you to the first million in sales. I'm not saying anything about profitability because that's a tough market to be in. But as far as being effective, not efficient, but effective, will be far more effective than you are. Now, whether we're profitable at it or not depends on the dynamics of the industry. I can't say would be profitable or that you'd be profitable, but I will beat you in development, I will beat you to market, and I will beat you to the first million by a handy margin. Because when you're working from home, you lose that serendipity that happens during the course of the day. That instead of coding for 3 or 4 days and then finding, you know what, maybe we should have done it this way or put this feature in, you can adapt on the fly, on the spot, right then and there. Here's another challenge I'll put out to you. If you and I both were employed at any kind of organization where there's upward mobility, and there is work from home or there is work from office. You work from home, I'll work from the office, I will be your boss in no time. And then I will be your boss once removed and twice removed and 3 times removed, and I will move up the organization. much faster than you will if you ever do move up the organization, because I will be embedded in the culture. I will be there and present. I will be a party to the big conversations, the impromptu meetings that you won't be a part of, the social events that happen after work that you won't be a part of. I will be there. You won't. I will beat you, hands down, all the time, and I don't even have to be the better person. Work from home. I'll say it again, and for the person who said speak for yourself, I am speaking for myself. Work from home is not a thing. It's not a thing. All right, let's continue on here. You made a video on risk management. I think I remember talking about how you can limit or recover from losses. Yeah, you can. Now, it's not all the time. You can, but I guess I'd say the big caveat there is you must act fast. You can't wait until, okay, now I'm really in trouble. You must say, I see trouble coming. And there's a part of you that says, yeah, it might recover though. You can't do that. As soon as you cross certain tripwires, as soon as you get a certain distance away from the price that you had, you have to implement risk management techniques early. Otherwise, it becomes very, very difficult to do. So you have to do it early, and that has to be really part of your plan before you go into anything. So last week, we did 13-week momentum. And one of the things I said is, before you pick the stock, look for the options. Make sure you have liquid options. Not a deal killer, but with liquid options, I have risk management techniques. I have things that I can do. I can step in and manage the delta exposure that I have. And depending on the implied volatility and the underlying, I may be able to work my way out of a problem. If I have that ability. If I don't, no options on something, all I can do is buy, sell, buy, sell. And if it hits my price point, then all I can do is a stop loss and I'm out. So you can work your way out if you follow your rules, if you're disciplined, and if you move in early. Now, there are times where something's moved against me and I've moved in only to have it change direction and go back, and I would have been better off had I done nothing. But that is the exception. It's typically not the rule. That's the exception. So there are times where it's like, I should have done nothing. But all the times when I should have done something, I don't say, I should have done this. Yes, it was good. So you remember those events of I shouldn't have done it. And those are the ones that sort of are immediate in your mind. You forget your victories. You remember what didn't work out, and you tend to keep remembering those things. Out of curiosity, to what extent did your risk management strategies limit your losses during 2008? I will say this, during 2008, I was not as financially sophisticated as I am today. I didn't use a lot of the risk management techniques that I have today. You learn them over time. But in 2008, I was short. I did see it, and I was short. And going into the end of 2000, end of the year, I think 2007, or it was the end of 2008, I think, the market was rallying. I'm trying to remember what year it was. Then 2007, 2008. Every New Year's Eve I like to go skiing somewhere, and at the end of that day, I'm checking in, and I had a BlackBerry back then, and I was just frustrated. Why is the market going up? And it was, I think, the first 3 months of the year, it was straight down. I was up 31%, but it wasn't because I was implementing any risk management. It was a directional bet. So I would say that a better question would be, to what extent did I use risk management techniques in 2008? Not a lot. Not compared to today. I was less sophisticated. I have been quite successful at rebalancing my portfolio in terms of adding or reducing beta when things become frothy or stressed, but find that I tend to be too early in getting into positions and building up size. Welcome to the club. I have found that is my biggest problem, is my timing. On my picks, I am mostly right. I have a very high hit ratio, right around 90% sometimes. When I'm wrong, it's usually because I missed something, and then you look back at something, you say, I don't know why I missed that or why I did that, but I'm usually right. But I am usually wrong on my timing. And in the market, being wrong on your timing is the same as being wrong. It's the same as being wrong on your pick. So I try to take timing out of it by giving myself the luxury of time, by giving myself positions in which I feel that, you know what, I can work with this, and I'll start risk managing early in the process. But there are times when something moves against you in a sustained direction in one way, like Beta did to me this year, where at some point you just get tired of the daily work, and when a position is moving against you with conviction, it is just tiring every single day to have to go to work and say, oh, okay, well, let's roll these up, let's do that, let's do this, let's minimize this move, let's minimize that loss. And you got to watch the screen because you have to be tactical. You have to wait for tactical opportunities to scalp. And it's just really tiring to get that done when doing that takes you away from something that has higher value added, right? So you have to think about how much time you want to spend doing that. You're too early to get into position, so am I. There was a friend of mine who related a story. He was a trader in Chicago, and he related a story about his manager having this strategy called the bloody soldier strategy. Is that he would send a soldier out on a trade. If it came back bloody, that was the end of it. But if it didn't come back, he'd send another soldier out. So in other words, he'd buy something, and if it went up and it didn't trip any stop losses, he'd buy more. So he would buy more in rising markets, sell more in falling markets. But if he bought something and it tripped his stop loss and it came back right away, he was done. That was it. So he had this, he called it his bloody soldier strategy. So you can try that. Allocation factories are good for building up positions. And if you want to get aggressive on an allocation factory, you can use 0.5 deltas, 0.6 deltas for building them. They work well if you have an underlying with weekly options, because if you start getting close to your allocation, you can then add some benefit to it by using out-of-the-money calls. So you might be using 0.5 delta puts, and as you're allocating, you might be using 0.2 delta calls. That may call away some of your underlying if it bounces from a drop, but it depends on how many shares you want. We will be doing an allocation factory in the applied series in portfolio management. We will set one up, and I think FCX is probably a nice one to use on that. Even at these low levels, TLT is probably a nice one to start an allocation factory on. Let's see. If you had any process for making an entry into a stock or ETF when the stock is somewhat in the short-term bear trend? Well, if it is in a short-term bear trend, I ask myself, is it something I want? That if I bought it, am I comfortable with it, and what's my holding period? If I'm swing trading, which I don't really like to do, swing trading is, short period of time. I don't day trade. I don't really try to swing trade. But if it's a holding that I want for a couple of years, then I don't mind buying it if it represents a good valuation. Now, a cheap stock can get even cheaper. I do know that. But it depends on what my investment horizon is and what my target price is. If I'm just buying something at 95 because I think I can sell it at 98, yeah, you kind of have to play with stop losses because you're only playing for a $3 gain. So you don't want to have a $4 loss on a $3 gain. So if you're playing for a $3 gain, you got to play for a $1 loss, a 1-to-3 ratio, which means you're going to get stopped out a lot on these kind of stocks. I believe we hold similar opinions about technical analysis. However, I do tend to try to find support and resistance lines for entry. I'll do that too. I mean, I'll look at a chart and I'll look at the trend because I want to see what those people who believe in technical analysis see. And I've made this analogy before. If I'm going to visit a country that is highly religious, I cannot ignore their religion. Because what if I do something that gets me in trouble? Because everyone's acting in a certain way. That highly religious society will act as if God were real. Hence, there will be real consequences because of the belief in God, thereby giving God real power in that society. I better be at least familiar with their religion. Technical analysis is like that. If you're stepping in to different types of markets, it's worth looking at the chart on different time periods just to see if there's anything that group of people are looking at as well. And if something is really obvious and you see something, it's like, okay, well, I know that I know there's a group of people that see this and they're going to play it because of that. And I want to know whether that's going to give me support or it's going to be a headwind in what I'm doing. But I'm certainly not going to start with Elliott waves and RSIs and MACDs and GANs and Fibonacci's and all of that sheer nonsense. I'm not going to go anywhere near that stuff. I'm just going to look for the obvious stuff. Gaps in the chart, moving averages, 200-day moving average, 50-day moving average, maybe even a shorter-term moving average, and trend lines, support, resistance, things like that. Just those obvious ones, but I'm certainly not diving deep into the crazy. TLT made a low on Thursday and bounced, which to some degree sets a support line. This is the first support line around that level in a long time. So hoping maybe you could talk about your process, how you would enter a stock that is somewhat downward trend, no clear support line. Well, I would think about what are the drivers of TLT. It holds mostly long-dated treasuries. The average maturity is 25 years, so it's going to behave basically like a 25-year bond. Or closer, the 30-year bond. It is going to behave pretty much like ZB would, or the 30-year bond. And it's going to behave like a risk-free bond, which means it's going to be influenced by beliefs about what real GDP is going to look like, what inflation expectations are going to look like, and where interest rates are going. And here's the thing. In any time of stress, money will run into U.S. Treasuries. On a relative basis, there's nothing better. There's no safer place to hide. And we had some numbers out of China that weren't very satisfying. And this morning, one of the central bankers, I think it was Harker, said, I think interest rate hikes are done, are pretty much over. Well, there we go. There's a bottom on TLT. There's a bottom on rates if you think it's almost over. And if you have deteriorating global economic fundamentals, you will have a rush into safety. I don't need technical analysis on the 30-year. I just need an understanding of where interest rates are going and the drivers of the long end of the curve. Last week I was looking at making an entry into TLT. I was put off by the fact that it kept making new lows, and in the end the only positions I made were selling puts on SPY as well as buying some short-dated bills. I bought 500,000 of the 25-year bond, which is emulating the same duration that TLT has. So I bought the 2048's August 11, 3%. Did that 3% funny, didn't I? Let me write that 3% again. You start with the top zero mark. The 3% coupon bonds, 2048. So it should give me a duration very close to what TLT has. And that gives me I got a 4.31. TLT's dividend yields almost 100 basis points lower. But I give up the options. I don't have liquid options on this one. What I have found is usually when there's some selling in something, day three is more common than not to get a reversal in price on the third day of selling. That's not a technical thing. If you think about in behind the scenes, when you have a big down day on day one, the very next day you're going to have margin calls. You're going to have margin calls in other parts of a portfolio, and you sell what you can sell. So there may be even more selling the next day, which triggers the next round of margin calls. And usually by about day three, that's pretty much over. The margin calls are over. At least the selling from margin calls are over, and then you can sort of find a floor, and then any catalyst that says that the selling was overdone, you can have the fundamental bounce back up, because you might have had a fundamental drop in price that was carried by the margin call, so you get that fundamental increase, which this is sort of what we got on last Friday. And gave back some on Monday and got it right back on Tuesday. Okay. Hang on, there was a little bit more here. To give a little more clarity, I was looking at selling puts on TLT, and as much as would take on the position equally, I wanted to just collect premium, which is why I didn't just commit at the 95 level. So I was wondering how you would go about it, as I know you sold puts at various levels around 100. Yes, 3 different strikes. And some are already being put to me. Some were put to me last week, and some were put to me yesterday, last night. The short side or the long side of the option has until 8 p.m. to declare their intention to exercise their right to put the stock to you, so you get notified later in the night. I have found decent correlation between Chicago Fed's National Financial Conditions Index and the price of SPY, especially between the National Financial Risk and Credit Sub-Index and SPY. That's probably because SPY is an element of the sub-index, since it covers a broad range of financial assets. Just wondering if it might be worth mentioning in your weekly, regular. Well, because it's an element of the index itself, you have you'd have multicollinearity. So if you were putting SPY and that index into a regression as independent variables to predict something, you'd probably have very low significance on the coefficients, even if the regression was significant, because you would have a form of multicollinearity in there. Question related to the portfolio management course. How should an average person think of retirement account in terms of portfolio management? Well, it's retirement. You don't want to spend a lot of time on retirement, and you don't want to touch it a lot. And it's a long-term holding. So you want to play the long-term average returns, which are fairly decent. You want some kind of rebalancing in there. So 60-40, I think, is still a good portfolio to have. Yes, I think it should be part of a buy and hold allocation. You will need rebalancing every so often. Average person being someone with a net worth of $250 to $1 million, with retirement account representing 15 to 30% of total net worth. Assume the retirement account has periodic contributions with the money invested in a target retirement. Well, if you got a target retirement fund, then it has you have a glide path. Right, so your target date fund may be a 2050 target date fund. So how that works is here's your allocation, this is your percentages. You might have, in terms of bonds and in terms of equity. I'm just giving a wild example, and here is your 2050 date, and you'd have this glide path over time that every so many years you'd have a lower equity allocation, high, and it would allocate more to bonds over time. So you might start with a 60-40 and end with a 60-40 this way. You'd still have some equities, but by the time you got to retirement, your equities would probably mostly be high dividend, low PE value stocks. So if you're in a target date fund, I think that's a good place to be. Unless you have the skill set to do it yourself, you may be able to get it done with lower fees, but you have to ask yourself about how much time are you going to spend doing that to get that done versus what it would cost you to get it done. And if you're thinking about 15 to 30%, and if you have a net worth of $1 million, you're $300,000 in your retirement account, I don't think the fee savings would compensate you for the time to do it yourself. Work from home study bit, poorly designed. Data entry work does not map well to other jobs. It doesn't have to map well to other jobs. It's not one study. It's one in a number of studies that have looked at different countries, different types of jobs. Different types of design. This was a randomized test where you had a group of people. Some were selected to work at home. Some were selected to work at the office. The interesting thing about this one is there were some people who were something like 20% faster than the baseline who were also assigned to the work from home. And they were better to begin with. So in the office, they were considered the faster ones in that setting, and when they went home, their productivity dropped. So it wasn't as if you were dealing with, you can't say, well, the people, if you're in data entry, you probably have spent your time getting by, and that's why you're doing data entry, because it is a low-skill job to do data entry. So maybe it's the type of people. But even within that group of people, there still will be a distribution of skill level within that people. There will still be some data entry people who are really good at it, and some that are really poor. So you can't just say, well, as a sample of all the people out there, it's not that great. You have to say within sample. You have to look at it in terms of being within the sample. There still would be the distribution within the sample. The findings are valid on that one. The setup of the experiment is valid as well. So the question is it corroborating other studies that have been done in other contexts? And there's a lot of these studies being done, and at some point you'll have what's called a meta-analysis, where somebody will come along and they will take all these studies and they will group it all into one big sample and do an analysis on the sample. But you need a whole bunch of these studies to get that done, and these are sort of falling in line with other studies that have been done as well with other types of methodologies. So if you're looking at a particular phenomena, call it X, and you have studies that are using the same methodology each time to look at X, that's not interesting. What you want to do is have a bunch of other studies looking at X with different methodologies. So method 1, method 2, method 3, method 4, context 1, context 2, context 3, context 4, geographical or cultural area here versus here versus here versus here. So maybe you have method 1 and job type here within one country, and then another researcher says, well, let's replicate that here because it might have been a cultural thing. And it's the sum of all of these things where you start to slowly rule out certain things, because no one study can rule out all the variables. So they're all incremental. It's one brick on the wall, right? And when you have a number of studies, somebody will then come along and group them all into one and do a meta-analysis on that. So it is, it's still, I think, a valid design. Let's see. I understand how large institutional investors such as pension endowment funds have specific mandates and allocations. But how is it that the market is moving up to almost COVID highs when fixed income is yielding some nice juicy yields? Yeah, well, I think you have to look at money, the idea that money has to find a home. So if asset prices are going up, it's because money has to find a home. So no matter how bad things get, you have relative investing. It's like, well, we got to find a home somewhere. So let's find the least dangerous place or the most desirable place in a bad neighborhood is basically what you're looking at. Given the level of the Fed balance sheet and given that you have government still doing a whole bunch of deficit spending, that's working against drawing liquidity out of the system, which is what central banks are trying to do when you have governments just pouring money into the system. Well, all of that has to find a home. All of that has to go somewhere. Because when a government spends $1, somebody else receives $1. So it all must find a home. The other part of that I would point out is you've had a significant increase in global wealth in the last 20 years. That didn't exist in the year 1999 or 2000. That the amount of wealth created globally in the last 20 years is huge. Well, all of that wealth has to find a home. It has to find something to sit in. It has to find some asset. With housing prices as high as they are, real assets aren't really that much of an alternative. Typically, when you have interest rates go up, you have housing prices go down, and real assets become also an alternative to risky assets like equities. Bond yields are nice. But right now you have home prices that in some markets are higher and hitting brand new highs, all-time highs. Well, then real assets aren't really an alternative at that point. So you may as well at least try to buy something else that's more liquid, and equity seem to be the place to be. So when you have a bunch of wealth that has been created that has to find a home, this is what's going to happen. You will get asset inflation in times when you don't think that you should be getting asset inflation. And maybe this is what's going on in the market today, and it maybe is part of my analysis that I missed during the year, is that it does not matter how bad things are. We have a fundamental shift in the amount of wealth in the world. We have a much higher level of global integration with economies now than we had in 2008. And it's that level of global integration and capital mobility that may be causing a fundamental difference or a fundamental change in what the minimum forward PE would be. That if we go out, if we have another 20 years of wealth creation, maybe we'll be saying, oh my God, the forward PE is down to 25. That's a buying opportunity. I mean, it normally is 32. Given a lack of places to invest in, we've seen this in real estate, cap rates keep going lower and lower and lower and lower because, well, where else are you going to go? If you want to buy, this is what you got to pay because there's nothing else. And it could be that maybe we have this kind of regime change going on where, given the level of wealth, given the propensity of governments to adopt deficit spending as the baseline, not as a temporary measure, but as the baseline, then perhaps a forward multiple of 17 or 16, the long-term average, is a history lesson and is not forward-looking anymore. Interesting questions. I don't quite know what the answers to them are, but they are interesting. Let's see. You briefly mentioned using structures to minimize territorial tax, dividend withholding tax for non-U.S. investors. The most common one to use is a synthetic long position. So rather than buying the stock, you will buy a call and you will sell a put. ATM, and this works better when interest rates are super low. When interest rates are really high, your options, your 1 year options, will be centered around the forward price. So I would follow a strategy when you have high interest rates. I would follow sort of a money market strategy on this: is buy 3 month at the money. Put in place 3 month synthetics. And just keep rolling them over every 3 months, much like you would roll over a T-bill. And this way here, if interest rates do drop, you're not stuck with 1 year options that have a cost of carry representing a high rate like 5.5%. You will roll them over at the lower and lower financing costs, because the risk-free rate, R, is in the price of the options. It's part of the cost to carry. Create synthetics, and you will minimize your currency exposure. You are dealing with capital gains now, not dividends. There is no withholding in this. The present value of the continuously compounded dividend will be within the option. It will be within the premiums that you're getting, if it's a credit or a debit. So it will be in there, but the higher the interest rate, the less desirable that becomes, because you are in essence using a carry strategy. So the dividend won't outweigh the interest rate, which means you're going to need delta to work for you, which means you're going to need the underlying to move up in price. But you can do that, and you can avoid a lot of withholdings. So we don't have to go through this. This is the easiest way to get it done, is with a synthetic, unless you have a lot of money. If you've got a lot of money, then you can start thinking about corporate structures wrapped within trust structures, etc. But you need a lot of money to get that done, because the setup cost is significant on the front end, which means the savings has to be big. Within, you got to have like a 1.5, 2 year payback on your setup costs at the most to justify that kind of thing. I'm thinking of buying in the money call option on TLT for January 25. Oof, it's a long way out. In the money, you're going to pay for that. You're going to pay a lot, because you're going to pay, what is that, 1.5 years at 5%. Because the options will be centered around the forward price, and with interest rates so high, you will pay for that. My assumption is the recent surge in the long end of the curve may not last long, and with 17 months ahead on this option, the possibility of Fed cutting rates aggressively. Yeah, I see what you're saying, but if the Fed cuts interest rates, you are left with an expensive option, because the price of that option will drop as interest rates drop. As interest rates rise, the price of call options rise. Because the call option is centered around the forward price, not the current price. So an in-the-money option with low interest rates might have had a delta of 0.9, would have a delta of almost 1 depending on how far you go. Yeah, you'll pay for it. Normally you want to buy longer term than shorter term because of theta. But with interest rates this high, you do have to think about the cost of carry on this one as well. When interest rates are low, it's an easy decision to buy a leap. Because the carry's almost free. When interest rates are low, right, money's free. The extra time that you're getting, the forward price isn't that much higher than the current price, but right now it is. 25, I think, is too long. If something is going to break, you'd know about it sooner than later, and we're already seeing little hiccups going on in different parts of the world. The U.S. cannot go it alone. They can't go it alone. 40%, 45% of the S&P 500 revenues are global. So they are exposed to a global market, and they cannot go it alone. So if there is going to be a global slowdown, the U.S. will not be an island. It may be the safest island. It may be the island that's sinking into the ocean at the slowest pace, but it's still going to be sinking into the ocean. I don't know that you need that much time. I wouldn't go out that far. Yeah, I would think about other options. What you may, even that probably wouldn't work. Here, I would be more willing to go out to January 2025 and sell a $150 put. Now, you got to be careful about early assignment because you're selling the put, right? But I'd sell the put and I'd make sure that there's enough margin, enough time value in there that it's not going to be put to me. But I'd try to sell, maybe not 150, but 130 or 120, whatever you think your target price would be. I'd be more willing to sell the put. Yeah, I still have negative carry selling the put, but I'd be more willing to sell the put than to sell the call, because if interest rates do drop, TLT will move up without the option, without the value of the call option deteriorating while delta is moving in my favor. Better if I probably drew a chart on that, but long-time viewer, subscriber, regarding your view on remote work, how do you reconcile the fact that you perform most of your work remotely from your home? I don't work from home. I work from my office. My whole main floor is set up as an office. It's not really home. It is an office. There is no home life for someone like me. Number two, I don't get a paycheck from anyone. I don't actually work for anyone. I work for myself. I'm sort of in that group of you eat what you kill, right? I don't rely on the company to pay my bills. I pay my own bills. If I don't work, I don't get paid. I don't get anything. I don't get any income. So I work for myself. People who are self-employed, if they have a bad work from home ethic, will not be self-employed for very long. So when I say work from home is not a thing, I primarily mean if you're an employee of an organization receiving a paycheck. But if you are your own person, if you have your own business, it makes little sense to incur the costs of paying for an office somewhere just to go somewhere to be alone. Now, I have an employee. I call her an apprentice because it's more of it's more in training than an employee. Work here. It's work here. There is no work from home. It is work here. And there are things during the course of the day, every single day, that if that person was not here on site would lose the richness of what I'm trying to get done for her. Would lose all the small little learning things that happen during the course of the day where I'm looking at something and the market's doing something. Say, come here a second, I want you to see this. They would lose that because you can't suddenly jump on a Zoom call. First of all, I'd have to send the email if they worked remotely, and I'd have to wait a couple hours for them to respond, and I'd say, you kind of missed it. It was something I wanted to show you, but it's gone now. So her learning would be degraded significantly. Her training would be much lighter and less intense, so that after 6 months, if she worked from home, would be nowhere near where she would be by being here for a month and a half or 2 months at a time. I think that would be easy. That 1 month here with me, you would learn a lot more than you would 6 months on your own. So I don't work from home because I don't receive a paycheck from anyone. Slightly hypocritical for you to be so opposed to it. No, it is not hypocritical at all. It's based on experience and observation of having my own business and having employees go home and work from home and seeing the fallout, seeing the effect, and being able to measure the effect. If you are if you are an entrepreneur and you are responsible for your own cash flow, then work from wherever you want. I have nothing to say about that because the market will determine your worth, right? Let's see. I think if Serify had 5 days in the office rule, your typical day would be very different. Well, I'm not an employee of Serify, so I don't think that would matter. But if I were, if they had bought my business and I was part of the management team, I would not be comfortable being in a different city. I would have moved in a second. If I had it in my mind that I'm going to join a management team for this company, and this is a company I can see myself growing in and moving up in, then yes, I wouldn't have been satisfied being a remote person in a particular role. I would have seen myself as being on a track at that point. Okay, at some point I'll be CEO. That would have been my thinking right away because that's how I think. And to do that, you can't do that remotely. You cannot build a team remotely. You have to be co-located. And that is one sort of thing that I will pick on with Serify is that I personally don't agree with the distributed workforce. They make it work. If you ask them if it works, they feel that it works for them. But if I were CEO, that would be the end of it. I would pick one town where the current key people happen to be, and I would slowly be hiring within that city. And you have an option to move to this city, or it would be, thank you very much. We'll find a role for you where remote work maybe works, but it certainly won't be on the decision team. It certainly won't be on the strategic team that I need co-located with me right here, right now. If it were me. I'm not the CEO though, so. Now, some CEOs may push back and say, oh no, we can do this remotely. And some CEOs may have a different vision of how they want to get things done, and that's fine. And it would require a different management style. Mine would not work with a distributed workforce because I'm too impatient. When I want to have a conversation, I want to have it in the next 30 seconds. I want to have it right now, and I want to talk it through right now, and I want to get somewhere now. I don't want to plan for a Thursday afternoon on Monday when 4 people show up. I don't want to do that. It has to be now. That's just my style. So, just curious to ask if you have a video, or what's your opinion as far as building up sizable positions in large Canadian banks and using income strategies to enhance your dividend yield. I believe you alluded in the past that you'd have something similar with REITs. REITs are easy to do. In that sense, in a good market. If you have a bull market going on, we're in a transition market because we really don't know what kind of market we're in, right? But when you're in a market where you feel, okay, the valuations seem fair and there's, rates are low, growth is there. Yeah, there's always some stuff to worry about. For the most part, you have, several years of pretty much upward movement in markets in general. REITs are easy because of the high dividend payout ratio. They're not really high growth stocks. So you can do quite well with REITs, plus the dividend yield gives them a floor. With the banks, you have a floor as well, but we have this issue in Canada about how much risk is sitting on the bank's balance sheets because of the residential mortgages we have. We have a different type of mortgage market, right? So you've got to look at those loan loss provisions on those mortgages, they are not as safe as U.S. mortgages sitting on bank balance sheets. In fact, if you look at how residential mortgages are risk weighted, they're weighted at 50%. If you're calculating your risk weighted assets in the U.S., it's a 50% weighting. I believe it would be much higher here because every couple of years, up to 5 years, you got to go back to the bank and renegotiate your mortgage, and you will be doing it at the higher rates. That being said, though, I think the Canadian banks are great to allocate, to build an allocation to, which means that take some of them and say, okay, well, I'm going to just sell 30 Delta puts on these every single month, and 1 or 2 puts, and if I get 100 or 200 shares, good. If not, well, I get the puts. I think it might be better to use the listing on the Canadian banks on the New York Stock Exchange rather than the Canadian Stock Exchange, because the options aren't as good. Canadian options, well, they suck. The options market in Canada is not as robust as it is in the U.S. Regarding your duration positions, 2 questions. What are your options on LEAPs, on TLT, if we're considering a rate cut? So I've already given my answer to that, is that they are centered on the forward price, not the current price. And with interest rates as high as they are, the forward price is much higher. Is there a way to estimate a theoretical floor or top to ZB futures for range of target Fed interest rates? Yeah, I did that some time ago. Understand that they have TLT has a portfolio has a duration of 17.6. So if you think that interest rates can go up another 100 basis points on the 30-year into the 5% range instead of 4.3, well, actually they're somewhere around under 4.2. If you think they can get to 5.2, then there's a 17.6% downside to TLT. That's what the duration will measure. I don't understand how it is priced. For example, it's priced at 120. No, that's ZB. That's a futures contract. 120 is the price for a theoretical 6% coupon bond, and 100 of them. So basically, the underlying is $100,000 of 6% coupon bonds at par. Yields are below that right now, so they'll be priced at a premium. And then it's a theoretical bond that doesn't exist. It's just a generic bond. There will be another bond called the cheapest to deliver that will be delivered along with some conversion factor that makes you indifferent between getting that bond versus getting brand new par bonds for $100,000 that yield 6% or that have a 6% coupon. You would be indifferent between the two. Does this mean it's priced as 20% bond premium? Again, that is it's a quoted futures price, not a forward price on the bond. Fed's target rate is 4.5 to 5.5. Can I estimate a price using bond mathematics for ZB? Not so much for ZB unless you knew what the cheapest to deliver was, but for the portfolio of TLT, it has a duration of 17.6. So that is for a 100 basis point change in its yield. So it is yielding 30-year yields 4.2. Well, actually, the average maturity of the bonds are 25 years. So the 25-year is yielding around 4.3, 4.2, call it 4.25 now, because I bought at 4.31 and I'm in the money on those bonds, which means the yield has to be lower. So if you think it's going to go to 3.25, then it can increase by 17.6%. Let's see. Can you go over how you came up with Theta allocation on your portfolio management course? There was no science behind it. It's like, well, let's just take a $50,000 sleeve. I could have taken 40, I could have taken 60, I could have taken $37,423.19, but I picked 50. Just pick any random number. I picked 50. And we're going to start off really conservatively with a theta of 0.001. And you multiply that out, and that'll give you your maximum theta per day that you should target. That makes sure that you don't get into trouble. That you're not selling a whole bunch of puts right up to the limit of your margin, and you're going to get a margin trip all the time. Now that we've done this, we've had a weak market since we've done that. We've had a market that has been going down. I've been checking the theta, the allocations I have, and none of them need to be closed at this point in time. I was hoping that we would have some that would need to be closed. But it gives you an idea of how badly things can turn on you if you sell a whole bunch of puts to generate income and the market drops. Then you're going to have to take loss after loss after loss after loss after loss. On one of them, on Rio, I said, let's sell a call. So the market is dropping. Well, the call is helping to offset some of the negatives that we have down here. In a true true Theta portfolio, when I say true, I mean we're going to get to this beautiful point in it. Maybe true is not a right word, but in a more perfect Theta allocation, you would have a delta, a total delta exposure close to zero. In other words, you would sell some puts and you would sell some calls such that your overall delta would be very, very close to zero. You want to be as market neutral as you can be and work on Theta, which means if the market goes in any particular direction, some of them will be working while some of them might work against you, but you're hoping that the puts and the calls that you've sold don't get triggered. When you're all on one side and you have a market like we had, then that brings up risk. But when you're trying to teach something, you don't want to always teach success. You, at some point, want to teach failure because you learn the most from failure. And, well, so far, I haven't seen the failure. If there is going to be a failure of one of the positions that we sold, it's going to be GM. But here we sold a call and we sold a put. But I think that as we continue going further, if the union rhetoric goes up another notch, then yeah, I think GM could probably trigger that $35 put, but we'll have made money on the call. Let's see. I want to know why you came up with 50, just for the hell of it. More importantly, how should we go about doing this so we do not get in trouble with dealing with margin calls? Well, you start off with a very low theta until you develop your skill and you find nice underlyings. You develop a skill in finding underlyings that work very well. And you build up a library of underlyings that work well for you. And then slowly you'll move this from 0.001 to 0.0015. Maybe you'll move it to 0.002. You slowly start moving it up. I appreciate if you walk us through your reasoning and how we can stay out of trouble. Oh, okay, just did that. As a European investor, we cannot buy US ETFs like TLT. Really? As there's no KID available. I'm not sure what the KID is. I guess it's something European. I know we can still sell zero data expiration in the money options and get exercised. Isn't that owning TLT? Do you have other ETF alternatives that we can invest in? Just buy the 25-year bond. If you are looking to own TLT, if you buy the 25-year U.S. Treasury, well then you have the same portfolio that TLT has. You have the same average maturity and the same duration without the management fees, but you lose the options on the underlying. Read an article in Wall Street Journal discussing how new lending by mREITs has dried up. New lending by mortgage REITs lending their money has dried up for larger names like Blackstone. Oh, lending for the mREIT for these. Okay. The article said the biggest risk posed to mREITs are margin calls due to loan portfolio deterioration. Well, I don't know that you'd call it margin loan as much as you'd call it increased collateral. I don't know that you would really call it a margin loan unless you're saying that they're borrowing long term against the securities that they're buying, but most of them will use the repo market or the dollar roll. I don't know. I'd have to read the Wall Street Journal article to see exactly what was said about this. I know mREITs are structured much more conservatively than they were in 2008. Any concern for margin calls on loans? Well, I don't know that I'd call it a margin call. A margin call seems to suggest that there was some arrangement whereby the collateral was financed to a certain amount regardless of the term of the loan. So if you have a 10-year mortgage in place, or a 5-year, let's say a 5-year fixed rate loan in place, if that has a certain collateral, if you're not in contravention of any of your covenants, I don't know that there can be a margin call unless there's a collateral test on the loan that says if the collateral falls below this value, you then have to top it off. I don't know. For agency, a lot of their finance mostly with they use a lot of repo financing, which is 1-day financing, and then a lot of dollar roll, which is kind of like a futures market, but with securities that look like something but are not the same thing. It's kind of hard to explain. Without reading the Wall Street Journal article, I'm not exactly sure what part of the financing they're referring to, so I guess I'm just going to say I'm in the dark on this one. I can't answer. What are your thoughts on Bill Ackman's strategy where he's shorting 30-year treasuries? He's arguing that there'll be higher yields because of higher persistent inflation. I need an increase in supply of treasuries coupled with QT. Well, this is sort of saying that what we have will continue on. And it's sort of a linear forecast in that sense, and I don't know that you can do that. We're already seeing some fragility. You had a Fitch downgrade the U.S. debt. You had Moody's today downgrade some banks, 10 of them, and saying, look, commercial real estate is not over yet. Everything that we think is over is not over. I mean, I don't know why we're so willing to forget, but everything that we had is not over. And yes, we do have higher rates and banks have higher funding costs. It's going to affect things. It is. So we have to accept that it works with a lag. That if you think, oh no, the 30-year yield, let's draw out our yield curve. We have an inverted yield curve. The 30-year yield is going to go up. You have to have a belief that your money market rates are going to stay elevated, and that the real GDP or expected inflation is going to increase, and that even with these staying the same, you're going to get a steepening of the curve. This would cause a lot of issues in terms of borrowing costs, I think, for the Treasury. I think things would start to get a little bit concerning in that case. And if you did have, if he's right in saying, okay, well, let's just ignore this, that expected inflation is going to be higher, then money market rates are going higher. And if money market rates are going higher, that is going to weigh down on the real GDP component, and inflation expectations will be tamped down. So if he is right that you're going to get a higher persistent inflation, the Fed will simply break the economy. And if you break the economy, then money has to flow to some safe haven somewhere, and that is always the U.S. Treasuries. So I think he's, I'm not going to say he's wrong. I think he would be well advised to have very tight shorts on that trade, or what you can do, find a hedge to that trade. So what you can do is say, I'm going to short ZB. I'm going to short the 30-year Treasury. Let's say you're going to do it through ZB. You're going to be short ZB, but you're going to be long ZQ. So that if the let's say it's at 94, well, let's say it's at 95 going out 1 year, or better still, let's say you're just going to do the front month on this one, which would be September, and you're going to be long the September ZQ, right? How can we get a short done and be long at the same time? You're going to have negative carry on being short here, because it is they are in backwardation. You're going to have some negative carry. But let's just worry about rate hikes and rate cuts for a minute. If rates go up, you will win over here, but you'll lose over here. And you can structure it. Well, then you're not. Yeah, it's not really hedge. You could use ZQ as a hedge if you think that rates are going to. If you think that you're going to get a bear steepener of the curve, with money market rates staying unchanged, being long ZQ is not a bad bet because rates are not gonna change. So you're good here, you're short here, you can make your money there. You make your money under the condition that rates stay the same, except you're going to get a bear steepener of the curve. And if you think that's going to happen, why not just do a steepener trade? Why not just do a duration neutral steepener trade and take duration out of the picture altogether? So it's sort of a lazy trade in this sense, because I can think you have duration risk, big duration risk if you're going to be short the 30-year, right? But if you're thinking that, well, these yields are going to go up, if you think money market rates are going to go up, I don't know that you can be short duration, because something somewhere is going to break. Something somewhere will break. You're already seeing some fragility. Something somewhere will break. Under the condition of stable money market rates, but higher inflation expectations and the 30-year yield moving up, if you're thinking that this is your scenario, just play a duration neutral curve steepener. Why take on negative duration? Just do a duration neutral curve steepener. So I don't know, maybe he wants to buy bonds, and from his pulpit he knows that if he says this, maybe enough sheep will come along and do his bidding and push yields on TLT higher so he can buy it. He's a trader. When a trader is showing you their poker hand, it's because that's the hand they want you to see. So he may not be telling the truth. He may not actually be wanting to do this. He may be telling you that he wants to do this so that you do it first, and then he trades against you, because it seems to me that if you're betting on a steepener trade, which it seems that that's what he's saying here, because if you're going to be short duration, you have to be agnostic about where money market rates are. If you think money market rates are going higher, then this component of the 30-year yield would go lower, working against your very thesis. It wouldn't go higher. So in essence, he could play a steepener trade if that's truly what his trade was. So it seems odd. What ratio is more important in evaluating fund managers? Information ratio. Information ratio if they're unconstrained, or not totally constrained. If they're constrained, then their information ratio means nothing. But as long as they're not constrained, I guess if it's an active manager, they will have some ability to express their beliefs. So I'd say the information ratio is better, assuming both managers have the same benchmark. Manager A has a higher Sharpe ratio, manager B has a higher information ratio. I'm just trying to think of how a higher information ratio could translate itself into a lower Sharpe ratio. If you are that much better at finding outperformers and underperformers, because the information ratio is the correlation between what you say is going to happen and what actually happens. So if you say stock A is going to outperform the index, and stock A outperforms the index, well, very good. But if you say stock A will outperform the index and stock A only performs in line with the index, well then not so good. So I'm just trying to figure out how you can have a higher information ratio given the same benchmark but end up with a lower Sharpe ratio. Unless what you're doing is you're being absolutely right on all the high beta stocks. Well, it could be. I'd have to think that through of how you could have that happen if you have the same benchmark. I live in Switzerland. Here it is not possible. I buy Swiss short-term notes for retail investors directly. However, through my IB account, I have access to US T-bills and Swiss futures. Can I use covered interest parity to directly earn Swiss risk-free rate? Yes, you can. There's a better way to do it. You can. Um, you can't access short-term notes for retail investors directly. It seems very odd, but yeah, you can do that. If you had UST bills and you hedged back into your own currency, you earn your own risk-free rate. If they're priced, if they're priced at no arbitrage. Now, sometimes they're not because there's a risk in the trade that you're not aware of. So it may not be priced at, they may not be no arbitrage priced. When doing fund selection, I try to look for funds that beat their bench over 3 to 5, 10-year windows. Otherwise, I choose an ETF for that particular segment strategy. What do you think of the drawbacks of this method? Well, it depends on what it is that you're looking at. Some performance is mean reverting. There's lots of studies that show, especially for more efficient markets like large cap stocks, that fund performance over a 4-year period reverts to the mean. That winners this period tend to be next period's losers, and this period's losers tend to be next period's winners over a 4-year window. That over 4 years there is no under or outperformance for the group. They all mean revert. That outperformers will then go on to underperform, and underperformers go on to outperform. That you typically get longer periods of outperformance when you have less efficient markets, like in small cap stocks, for example. So it depends on what it is that you're looking at. You're retiring from managing your portfolio by the end of the year? No, I'm not. I'm leaving Canada. And I don't want any return attributed to 2024, because then it's this complicated filing process I have to go through, because in 2025 I'd still have to file Canadian tax returns for that portion of the year in which I generated income. So I'm trying to have the cleanest source of income before the end of the year, which means backing out of as many investments as I possibly can going into the end of this year, and sitting in bonds or money market rates, and something that I can transfer to the next money manager, which I've already selected, by the way. It's going to be JP Morgan. I've already selected where the money is going to be going. So if I can get that all in by the end of the year, then I'm clean. Then I can basically tell CRA that I have disposed of all of my holdings as of year end, that there's nothing, no cleanup I need to do January 2nd. It's all been done by the end of the year. So that's what I'm trying to get done. But once I get to where I am, Interactive Brokers does exist in Costa Rica, and I can still trade the U.S. market. So nothing will have changed for me in that sense. I'll still have some small allocation. When I say small, it's still significant, but some allocation of the overall wealth that I still manage myself. It's just because I'm leaving Canada, there's this messy divorce that you have to go through, and it's just one of the things that makes it easier to separate if I do this. Would you consider the interest expense of a non-financial company part of its operating and financing activities? It depends on what I'm financing, I guess. I see most cash flow statements reporting interest expense as cost of doing business and reported as part of CFO. Well, you can adjust that, right? There is, if you're looking at a whole bunch of different companies, and depending on what standard they're reporting under, whether it be GAAP or whether it be IFRS, sometimes you'll find interest expense in CFO, sometimes you'll find it in CFS. You can back it out of CFO and put it into CFS. However, my belief is that working capital is necessary for a business. So if you have short-term debt that is used to finance your working capital, or increases in your working capital, especially around your busy time of year, that is part of operations. That really isn't part of your capital, I would think. That is a temporary increase in debt financing you use to finance your working capital for a period of time. I feel that's operations. Now, if you have a business where some asset appears on the balance sheet over a period of time because it needs to be constructed or built, the financing costs of doing that are in the price of the asset. They end up either in inventory or on the balance sheet. And then when you sell it, it ends up in cost of goods sold. So you are smuggling it into the CFO section to some degree. But what companies have to do is, wherever they put it, they typically have to disclose to you in the cash flow statement how much interest expense is in the statements and how much income tax is in there, so that you can back it out. So the easiest thing to do for comparability is have a rule. Either you back out all your interest expense out of CFO and you put it into CFS for comparability, and that's it. And this way here you're comparing apples with apples. The other side of that is, well, why would you put anything in operations? Why would you put any of your debt financing costs in operations? Because capital is debt and equity. Why are you picking on just the cost of debt as one cost of capital that shows up in CFO when equity has a cost as well? Should there not be an equity charge to your cash flow from operations if you're going to do that? So you may as well put it in financing, because there's where you have your dividends and your share buybacks that go on in financing. You may as well put it in there because the equity goes in there. Maybe, the interest expense, because it is a cost of capital, should go in financing as well. I think it probably is, best to try to take as much interest expense out of CFO as you can, but if it's smuggled in through inventory, it's going to be hard to get done. And if it is short-term debt that's used to finance increases in working capital, seasonal increases in working capital, I would argue that that's an operational issue and not necessarily a financing issue. That you had this temporary increase, but you don't want to take on capital for temporary increases. So that it makes more sense to use short-term debt, which is an operational thing. You can have a good debate about that, I think. What do you think about TMF, the 3x levered ETF for TLT? I don't touch any daily. This is daily returns. That's not over a period of time. It's daily returns. These things walk themselves to zero over time. Would you recommend someone goes through all the sector studies, or rather the sectors they want to invest in? The sectors you want to invest in, I think, should draw your attention. I only have 5 of the 11 sectors up, and I've been adding more detail in them. I just put another one up for banks today, capital adequacy. So it's like almost a 4.5-hour series for understanding banks. That's complete now. And I think I'll probably add this fall, I'll be adding utilities and energy, 2 more sectors. Maybe I can try to get industrials in there as well, but I'm going to add more sectors. They'll eventually have all 11 sectors. And then within the sectors, there'll be more industry-specific videos. It's an ongoing labor. We'll say it has no end date. It's just an ongoing labor. But start with what you're interested in. But I think it's important to watch the others as well. Even a sector you're not interested in, it's important to watch this to sort of just understand. Say, oh, okay, I get that now. I see what's going on there. Any thoughts on Ackman as bet against long-term treasuries? But he gave that one. What are the implications of the fiscal situation in the U.S. on growth? Does the continually increasing debt level pose a significant risk to the medium to long-term outlook of U.S. stocks? Well, that's interesting. I don't know. I think, you have to think like a trader, and you have to think about, what's good for me, not what's good for the country. And what might be good for you as an investor might be terrible for the country. So maybe what you want to see is a lot of deficit spending, a lot of spending by government, a huge component of G, the government part, to GDP. So that growth and labor and everything is on fire, and there's inflation going on, and it's just wonderful, and stock prices and earnings are going up at nominal levels, because you get to play that, and you don't really care how much it destroys the future economy or how much it destroys future generations' ability, because you are getting your piece. So you have to separate yourself from being an investor and being a citizen in an economy that is doing this. I'd be more concerned as a citizen, a tax-paying citizen in an economy, and I'd be really concerned if I was a successful tax-paying citizen in a country. Because when the bill comes in, and it will come in, and they have to get this money, well, they're not going to get it from people who don't have the money. They're going to get it from people who have the money, which means your fair share will not be 53%. It'll be 60 and 65 and 70%. There'll be more taxes on those that can pay it. They will come after successful people. They call successful people rich, and they say it in a disgusting way to make it sound like you're a criminal, that you're greedy, that you are the problem with society today. the rich. The rich aren't paying their fair share. Wrapped up in there is greed. In that statement, you're wrapping up an implied statement of greed. The rich aren't paying their fair share. They're getting away with something. They're stealing from everybody. They're making their money on the backs of everybody. And that's what politicians do, because successful people are a small group of people. They do not change the direction of elections, but those at the bottom do. And there's nothing more satisfying than hearing that your lot in life is not your fault. It is those people. It's the rich people. They're the ones to blame. They're the ones that are not paying their fair share. They're the ones that are trying to get away with something. And it's a lie. It's all a lie. It's one big lie, and politicians know they're lying when they say that. They know they're lying, but it doesn't cost them any votes, and they don't care. Right? So politicians don't care about you, and politicians don't care about the economy. Why should you? Do what I do. Leave. Just leave before they decide to knock at my door and say, you got something that we all need. In my retirement account, I have the option for mutual funds. Are there any you would look at in energy and mining? I'm not familiar with any of the mutual funds there, so I'll pass on that. I'm from Europe. My portfolio is denominated in euros, but I get my salary in US. 60% of my portfolio is in US. I like the yield on cash. But with the falling US in the past year, I've stayed flat despite the interest. Well, the euro is having trouble around, I think, 110, right? Recently, I've been converting all new deposits in euros to rebalance. But what are some other ways I can hedge a drop in US against the euro while holding more US for a higher yield? It's going to be hard because as soon as you get into any kind of hedging security at all, you're going to get involved in the carry of that security, which will take away the yield that you're getting out of the U.S. That is a difficult problem that every manager with a portfolio of different currencies has to deal with. Is what do I do with my currency exposure? Do I leave it? Or do I convert it back into my own home currency? If I do, I may be taking away some of the very return that I'm in the country to get. So there is no easy answer to that. It is, I guess, you got to do what's right for you. I have US dollar exposure, but because I always need US dollar exposure, I think, from day to day, I don't really care what the Canadian equivalent of my US dollars are, because I need US dollars anyways. But when the Canadian dollar gets to extreme points, I'll start thinking about putting hedges in place to hedge some of this out or hedge some of that out. So when the Canadian dollar got to about 131, under 132, I took off all my hedges and said, what do I need to hedge for? I think the Canadian dollar is as strong as it's going to be for the year, and I think it weakens from here. And so far, I've been right. Today, it went to almost 135 before bouncing to 134.25. But I've been right on that, and I will hedge out around 136, 136.5. I'll start to protect some of my position by saying, okay, well now I have too much US dollar exposure, so let me hedge out some of that into Canadian, because I'll think that, well, then it's 2 weeks. So I look for extreme points where I want to step in or step out. But right now I'm unhedged on my US dollars, because in my thinking, I'm not converting those US dollars back to Canadian. I'm really just hedging out the Canadian value of those US dollars, but I'm not looking to convert them into my own domestic currency. But if you need to convert those US dollars into euros because that's what you got to spend, well, then you got to do what's right for you. But if you do it over time, you will do it on a moving average. I think you'll be okay with that. I'm surprised you didn't sell more out of the money puts on TLT. I bought Treasuries directly. If you weren't relocating, I assume you indeed sold those puts. Look, I have I have some tens of thousands of shares that'll be put to me if TLT stays below the strike prices, which I'm kind of hoping it does in a way. I'd like to see it stay below $98 before August 18th. I would like some of this stuff put to me, but no, I don't know that it would have changed my mind. I decided just to go into the Treasury directly. The Treasury directly will transfer to the U.S. I'm trying not to open up new positions as much as I can. I have to fight the urge to do it on certain days, but it's part of the cost of moving. But I did buy more duration. I bought 500,000 of the 2048 30-year, 25-year maturity treasuries. What do you make of the ongoing proposal to up the bank reserve requirements? I don't know if the proposals are to increase the bank reserve requirements. The proposals really wouldn't take effect. The ones that they're talking about now wouldn't take effect until July 1st, 25, and would be fully phased in by 2028. And what it does is it's right now there is a requirement for the CET1 ratio over risk-weighted assets. If you are greater than $250 billion, a bank over $250 billion, you calculate your ratio two ways. Your numerator stays the same, but you have an advanced approach to calculating your risk-weighted assets, which just includes more categories of risk-weighted assets. And then you take the minimum of the two, which is the more stringent one. This is going to be replaced with maximum, and in this one here, you lose the ability of using internal models to generate your risk-weighted asset value. You have to use a standardized model that is given to you to generate your risk-weighted assets. But after you calculate the two, you take the maximum of the two, and this 250 drops to 100 billion. And in your numerator, you must also consider the unrealized gains and losses on available for sale, which is mostly done if you're over 250 billion, because the accumulated other comprehensive income is holding it and it's part of the capital. So for some banks, it will actually lower their capital requirements, not raise their capital requirements. Only for the largest banks would it raise their capital requirements, not by much. Like you're talking about single-digit percentages, something like 9% or something like that. Not the ratio going up 9%, just the numerator going up 9% in value. But it's not clear overall that it would raise capital requirements for all the banks. So it's not entirely clear at this point. But bank reserve requirements have been going up over time. What is your comment on, okay, Bill Ackman again. You said happiness was the wrong thing to pursue. What should we pursue? Better listening skills is one of them, because as soon as I said happiness is not the thing that you should pursue, I said it's meaning. Find meaning in your life. So had you listened for another 15 seconds or listened, you would have heard me say it is meaning that you should look for. Listen, there are people who have had difficult lives. Mother Teresa's life was not an easy life. But she was probably died content, because her life had significant meaning, but it was not an easy life. You could not say that from day to day she was pursuing happiness. She had meaning, and when you have meaning in your life, you can survive any type of how. You know, how you live your life is not as important as why you live your life. So happiness is more along the lines of how you living your life. As happy as I can be, but why are you living your life? And happy people don't, I find, if you're looking for happiness tends to come more from entertainment than anything. Is the why is missing. But if you have a why, how you live your life is not that important. It's the why that matters. You have meaning. Look for meaning, not happiness. Look for meaning. And you will generally be happy no matter what's going on in your life. You know, it doesn't mean that you have to be smiling and elated and entertained and happy every minute of the day and absolutely content with everything. You can say, you know, look, a lot of things in my life could improve, but I am generally happy with where I am in life because you have meaning, right? You mentioned moving out of Canada. Are you still considering moving to the U.S. or only considering Central America, Dubai? Well, first 2 weeks of September, I'm in Costa Rica and Panama. And if I don't like what I see there, then later, about a month later, I will be in Dubai. But yes, I am still moving out of Canada. I was considering U.S. briefly, but even in the no-tax states, it's still a significant tax rate. And it's kind of the same North American culture that I have now, and I really want to experience different things. So, it seemed less desirable. Could you please make a video on Japanese yield curve control mechanism? Well, I guess I could. Yeah, I guess I could. I don't know if I'm going to have the time with everything that I'm doing, though. What can we expect as far as additional August L3 seminars and Q&A with your upcoming travel plans? Nothing changes with my travel plans. I'm traveling after the level 3 exam starts. So there are no sessions. All the sessions will be done. All the sessions will be done. And no matter where in the world I am, I can do these sessions. I just need a reliable internet connection. That's all. Nothing will change. In fact, you don't even, if you didn't know what city I lived in, you would know what city I lived in. I mean, I'm just outside of Niagara Falls, but if you didn't know that, you wouldn't know that, because I can do this from anywhere. Which books do you suggest for portfolio management? That's a big topic. You got to be more specific. I'm considering advances in active portfolio management. Are there books you could recommend? Well, I guess it would be the question of, well, what is it that you want to learn? Because some of these textbooks, especially in active portfolio management, can get very mathematical and very complex and very theoretical. So it's, what are you trying to learn? Are you trying to learn the art of portfolio management, the strategy of portfolio management, or the math of it? If you're looking for more hedge fund style strategies to implement in a portfolio, you're not going to get that in that kind of book. Do you need a Refinitiv subscription to get the Week in Earnings Researchers? It's free. The Week in Earnings is given to you every week for free. Just Google it. Just Google Week in Earnings Refinitiv, and you'll get to their website. What's your counter to those who are shorting TLT? Already answered that. Can you tell us a little more about the factors behind your decision to leave Canada? The tax rate is probably the biggest one, and the rumblings in behind the scenes that those tax rates are going to go higher. If the Liberals and the Socialist Party, the New Democrats, win another mandate, well, neither one of them won a mandate. They're both minority parties who form a coalition government. But if the Conservatives can't win a clear victory, you're going to have another coalition government. And the biggest fear is that you actually get a very small Conservative showing, where the Liberals and the New Democrats split the vote. Then you have two prime ministers. You'll have one prime minister in name from the party with the most seats, and you'll have the invisible prime minister. Right now we have two prime ministers, Prime Minister Trudeau and Prime Minister Singh. And I use Prime Minister Trudeau with very little respect, by the way. The title is the title of the office that kid happens to be in, and that's about it. They will raise tax rates, and they won't raise tax rates on the bottom 70%. They won't cut spending either, and they'll raise tax rates on successful people. So just to show you how ridiculous it is, I got a 53.5% tax rate. Out of the rest, I get to spend, and I spend a 13% sales tax if I want to spend it, unless I'm buying something that's considered luxury. So let's say I want to buy a car, and it's a $200,000 car. And I have the income and the wealth to afford that. I should be able to, with my after-tax money, be able to live the life I want to live. And they say, well, you'll pay 13% tax, but, other people can't afford this, so why not pay another 20% tax on that, if you don't mind, please. So anything over $100,000, I now must pay another 20% tax on. Tax my spending, tax my luxury spending, or tax my income. But don't come and get me from both ends. Pick one or the other, but what you're doing is saying, you're successful, so here you go. And then when I go to spend it, oh, you're successful, so here you go. Here's another tax. Come on, man. Pick one or the other. I know you're out of ideas. I know that your simple-mindedness, this liberal and socialist simple-mindedness, is simply out of ideas on how to create more wealth for the country other than just to take it from people. But this is confiscation. This is not taxation anymore. There's taxation up to a point, and then there's confiscation. Well, I am not going to be a horse on this animal farm. Let's see how many of you can name that reference. And that's number one. Number one is it's just a sense of fairness. It's not a sense of greed, it's a sense of fairness. You give me a 40% tax rate and a 13% sales tax rate, where my tax rate is the same as everybody's tax rate. If I spend more, I pay more in tax. If I buy a $200,000 car, I pay $26,000. If you buy a $50,000 car, you pay $6,500. I pay 4 times as much as you because I spend 4 times as much as you. That's fair. But to suggest that because I can afford to spend more, I should pay even more just for that right, when you take away even more from me, that's confiscation. Give me a 40% tax rate. I would not be leaving because of taxes. I would say, well, that's fair. I mean, you got to pay for public schools. I'm a big fan of education. I don't mind paying for public schools. Okay, so we have socialized medicine. It sucks, but we have socialized medicine. Okay, I'll pay into that. We have an army. We have, all of these things. We got to pay for government service. I don't mind paying for that. This 20% over here, luxury tax, that is state-sanctioned confiscation. Once you exceed a certain tax rate, that's unfair. Now I'm being treated unfairly. So if you're going to treat me unfair, I'll leave. You would never hang out with a group of friends that treat you unfairly all the time. If they stick you with the bill all the time, even if you could afford it, if they stick you with the bill all the time, at some point you would say, look, I'm not greedy, but it's bloody unfair. I know what you're doing. You're just using me. So you'd stop hanging out with them. So I'm going to stop hanging out with the government of Canada. They lose me. Another interesting story that supports what I'm doing here is if you look at Alberta. We have one province, Alberta, where the tax rate is actually lower. I can lower my tax rate 5% by moving to Alberta. The number of people that are leaving Ontario for Alberta, I saw a chart, and if I can put it up on Sunday's Market Outlook, I will, and it looked like this, and then it just has been going straight up, leaving Ontario for Alberta. So Ontario is losing it. Ontario is one of the higher taxed provinces. Ontario is losing its tax base, and now it's going to lose me. My decision is already done. The other big decision, the other big reason is I just want to change in culture. I want to see the world. I mean, that's what everybody wants when they retire, right? When you achieve a certain level of wealth, it's let's go see the world. Let's go see everything else. But it's the fairness. It's the fairness that really tipped me over the edge. The talking about going to 56% because I'm just not paying my fair share. And the implication that somehow I'm lying and I'm cheating on my tax. Listen, at my level of wealth, and people like me with my level of wealth, we don't deal in cash. We leave footprints everywhere we go. We have to blatantly lie on our tax return. We don't get to just say, oh, I only made this much, like a waiter who makes $300 a night in tips but only claims $50 because you can't tell that the other 250 showed up. I have to blatantly lie and get caught in the lie because everything I do, and for people like me, everything we do leaves footprints. We don't walk around with cash. We don't deal in cash. So, when you have a government that demonizes you all the time and then confiscates your wealth and talks about confiscating more of your wealth and even talking about a 2% wealth tax, that after we tax you, we're going to come back next year and tax whatever you have left over after taxing you. It's like, I see where this is going. I'm done. I don't mind paying my fair share, but I'm not going to be taken advantage of it. I'm not going to live in an unfair system, and it's an unfair system. I think, you get me started on this excessive taxation. You get me started on the demonizing of successful people. I lose it at that point because it is capital that makes a country great. Capital. It's not called laborism. It's called capitalism. Capitalism. And if you think that you can build a country without wealth, there is no evidence that works. Imagine that there's no wealth. Well, go to the bank and get a mortgage for a house. The bank will say, well, great, as soon as people show up with savings.
Well, you need people with extra money. That's what savings are. And there are some investments that are big and bulky to make where you need some people with large amounts of investment to make that. Otherwise, there's no investment, there's no growth, there's no job creation, nothing. All of that goes away. If you decide that you don't want anybody to have anything more than anyone else, if you decide that, well, we don't need a society of any rich people whatsoever, you will achieve equality. When everybody is equally poor and equally miserable and living in government housing because no one can afford to buy a house because no bank has any savings to be able to lend you so that you can go buy a house because nobody has any wealth. Wealth is what makes capitalism work, and capitalism is the one system in the world where you have absolute upward mobility. You don't have upward mobility in socialism. Okay? So anyways, I get carried away whenever it gets to those topics because I'm just so sick and tired of the simple-mindedness of modern-day liberalism. A couple of questions regarding agency. How do they end up paying and maintaining the high dividend yield? Well, you have to look at their cash flow from operations. You have to look at a measure of their net interest income and dollar roll income. That determines their ability to pay the dividend. You have to ignore all of the non-cash charges, which when interest rates are going up, you're going to have a lot of fair value changes that hit the income statement because they're not banks. So those fair value changes hit the income statement, but they're non-cash. So if you look at agency, if you want to know more about agency or dive in agency, in the applied series and bottom up, there is 2 videos for agency. And later this week or early next week, Freeport will be up. Freeport's a long one. It is detailed, but that'll be up in the bottom up. And then I think I'm going to do GM. If you look at agency stock performance for the last 10 years, it's down significantly from a high of 35-ish to where it is now. Is that primarily due to the rates environment? Well, I don't know. I haven't always been an investor in agency, so I don't know. I really don't know what to say on that one. It would require me to go back in time and do some analysis of the evolution of their balance sheet. You're right about work from home. As one of my friends used to say, it's work from. It's not from, it's work for home. Yeah. Do you think the uptick in Treasury issuing debt a signal that yields are going to rise much higher? No. Well, first of all, no, I don't think that is a signal that yields are going to rise much higher. I think it's something that may put stress on yields, but you got to watch the auctions. I think there's $100 billion being auctioned this week. Look at the bid to cover ratios. If the bid to cover ratios are good, then there's appetite. There's appetite for that debt, and it's not an issue. You're right about YouTube analysts. Well, you're generous with calling them analysts. YouTube talking heads, just parroting views they hear from mass media. Content is high quality. Can't believe it's out there for us. Oh, well, thank you. Do you have a list of podcast people on YouTube that you have respect? Howard Marks. Asness from AQR, I think he's from. Ed Yardini. Princeton. Any of the universities that host speakers usually have fairly sensible speakers, not hyperbolic speakers, but fairly sensible speakers. Thanks and best wishes for the move out of Socialist Canada. Yeah, we are leaning more and more towards that, aren't we? Are the industrial sectors canary in the coal mine? I don't know. It's interesting. We do have a larger and larger cohort that are retired that tend to spend their money on services and experiences and not so much on goods. So it just could be that goods are making up a smaller and smaller proportion of the economy over time, and they have been, that we've had this quantum leap ahead. There's not this slow bleed where the industrials have had time to adjust by shrinking or the population of industrials shrinking, but you had this jump where there was this dislocation very quickly in demand for goods being shifted over to demand for services because of that cohort. this is a theory. I mean, it's my theory that you have this pileup happening now in the retirement category, becoming a larger proportion of the population. Less demand for goods. It simply just could be a regime change going on in the economy, and not necessarily a prelude to something. It could be, or it could be a canary in the coal mine. It could be. Do you think? I think here's what I think is more of a canary in the coal mine. Not so much the industrial activity within the U.S., but China. China's the factory of the world. Watch that. Watch China, because if we're looking for the canary in the coal mine, is going to be, well, where does most of the industrial activity occur now? And the U.S. has outsourced a lot of that to China. So it is not so much of how the industrials in the U.S. doing, because goods production has been a shrinking part of the economy for 40, 50 years. Look at it in another part of the world is saying, okay, well, what is the factory of the world? Watch that. And the data has not been good. Do you think oil price acceleration will have an effect on July inflation rate? No, I don't think so. I don't think so. Yeah, I'm gonna say it probably would be very minimal. Let's see. In the future, is this how the market outlook videos will be structured, starting with events? Sometimes the data makes more sense when you know what events happened during the week. Other times, the event is really just the backdrop that we had, and there wasn't anything really significant. But I have started with these things before in the past, when I dissect what whatever the Fed meeting did, or what the Fed minutes are. But it just made sense last week to start with what happened, because it's hard to understand rates until you understood the sluice, which happened on Monday, the Fitch downgrade, which happened on Tuesday, the Treasury statement, which happened on Wednesday. All of that was the catalyst, was the driver of all the activity last week. Work from home is a thing. I've already addressed that. Next manager, I thought you managed your own money. Part of my money, it's too big for me to manage on my own, and I'm thankful for that. But it is too big for me to manage on my own. And I've said this before, it is important to have diversification of strategy. If I were doing it, there would be one strategy. So you need diversification of strategy so that you have diversification of opinion and diversification of belief. So yeah, you were only wrong on the fiscal stimulus part. The economy is engineered. MMT is alive and well. It seems so, right? The human in the bear costume. Yeah. How many level 3 mocks should I do? I don't know that there's an answer for that. I think more than one, for sure. Probably 4 or 5. I'd probably say for level 3 AM, for the structured response, you'd probably want to try to get as much practice as you can. Let's see. You work from, okay, I already answered the work from home. And that will take us to the end of this. That's it.